Insurance is a way to transfer financial risk. Instead of one person carrying the full cost of a fire, crash, medical bill, theft, or lawsuit alone, many policyholders pay premiums into a system that can cover the few who suffer a covered loss. The important word is covered. Insurance does not pay for every bad event. It pays only when the event matches the policy terms, limits, exclusions, and claim rules. The premium is the price you pay for that protection. Insurers estimate how likely a claim is, how expensive that claim could be, and how much it costs to run the business. That is why a safer driver, a newer building, or lower-risk customer may pay less than someone with a higher chance of loss. The premium is not random. It is the insurer's price for accepting a specific risk. Coverage defines the promise. A home policy may cover sudden fire damage but not normal wear and tear. A car policy may cover collision damage only if that coverage was purchased. A health policy may cover certain treatment but require a network doctor or prior approval. The first job of any policy is to say what kind of loss belongs inside the agreement. The deductible decides how much of the loss stays with you before insurance starts paying. If a repair costs $1,000 and the deductible is $250, the insurer does not usually pay the full $1,000. The customer absorbs the first part. This is why small claims may not be worth filing. The deductible keeps minor losses with the customer and reserves insurance for larger shocks. Exclusions are just as important as coverage. They are the situations the policy does not intend to pay for. Flood, gradual leakage, pest damage, intentional acts, or business use of a personal item may be excluded depending on the policy. Many claim disputes begin because the customer remembers the broad promise of protection but did not read the exact places where that promise stops. Underwriting happens before the policy is issued or priced. The insurer studies the risk and decides whether to accept it, reject it, or charge more. For car insurance, that may include driving history and vehicle type. For home insurance, it may include building age, location, roof condition, or security features. Underwriting is the reason two people can ask for similar coverage and receive very different prices. A claim is the moment the policy is tested. The customer reports a covered event and provides evidence. That evidence may include photos, receipts, repair estimates, medical records, police reports, or proof of ownership. The insurer then checks what happened, what caused the loss, whether the policy was active, and whether any exclusion applies. A claim is not only a request for money. It is a request to apply the contract to a real event. Cause of loss matters. A roof damaged suddenly in a storm may be treated differently from a roof that failed after years of neglect. A burst pipe may be different from a slow leak that was ignored for months. Insurance usually works best for sudden, accidental, covered losses. When the cause is old damage, poor maintenance, or an excluded event, the payout can be reduced or denied. Policy limits set the maximum amount the insurer may pay. If the contents limit is too low, a theft claim may not replace everything that was stolen. If liability coverage is too low, a serious lawsuit can exceed the protection. Limits are where people often underbuy insurance because a lower limit can make the premium cheaper. The problem only becomes obvious when the claim is larger than the amount purchased. Valuation also changes the payout. Replacement cost coverage tries to pay what it costs to replace the item with a new equivalent, subject to policy rules. Actual cash value usually subtracts depreciation. A 10-year-old sofa, old laptop, or aging roof may not be valued like a brand new one. Two policies can cover the same event but produce different payouts because they value the damaged property differently. Insurance is not a maintenance plan. It does not normally exist to replace old items simply because they wore out. A homeowner is still responsible for upkeep, repairs, and preventing avoidable damage. If a pipe leaks slowly for months, the issue may be treated as neglect or gradual damage rather than a sudden accident. That difference can decide whether the claim is paid. The system also depends on honesty. False claims, inflated repair bills, fake receipts, or exaggerated losses make insurance more expensive for everyone and can lead to investigation or denial. Insurers check claims because the money paid to one customer ultimately comes from premiums collected across many customers. Trust matters, but documentation matters too. A truthful claim with clear records is much easier to process. Large disasters require another layer called reinsurance. Insurers often buy insurance for themselves so one hurricane, wildfire, flood, or earthquake does not destroy their ability to pay claims. Without reinsurance, one regional catastrophe could create thousands of claims at once and overwhelm a company. This is one reason insurance pricing can change after major disasters, even for people who did not personally file a claim. Regulation exists because insurance promises are only useful if companies can pay when losses happen. Regulators may require insurers to hold reserves, treat customers fairly, explain policy terms, and follow claim handling rules. The goal is not to remove every dispute. It is to make sure companies do not sell promises they cannot reasonably support when policyholders need them. Cheap insurance can still be expensive if the coverage is narrow. Two policies may have similar premiums, but one may carry a higher deductible, lower limits, stricter exclusions, or weaker claim terms. Comparing only the monthly price is risky. The better comparison is what happens on claim day. How much you pay first, what is excluded, how much the insurer can pay, and what proof is required. Insurance needs can change as life changes. A renovation may increase a home's replacement cost. A new car may require different coverage. Marriage, children, valuables, business equipment, or rental activity can change the risk profile. An old policy may no longer match the life it is supposed to protect. Reviewing coverage after major life changes prevents a painful surprise later. A denial is not always the final word. Customers can ask for written reasons, review the policy wording, submit missing documents, correct errors, or appeal through the insurer's process. Sometimes the claim is denied because the event is excluded. Sometimes it is denied because the file lacks proof. Knowing the difference matters because one problem is contractual, while the other may be fixable with better evidence. Insurance works best when the buyer understands the trade. The premium buys protection against specified risks, not a guarantee that every loss will be paid. The deductible, limits, exclusions, valuation method, and documentation rules decide how the protection behaves in real life. A policy that looks simple on the first page can become very specific once a claim is filed. The value of insurance appears when a covered loss would be too large for one household or business to absorb alone. A serious car accident, major fire, medical event, or liability claim can change a person's finances overnight. Insurance cannot prevent the bad event, but it can prevent one covered event from becoming a financial collapse. So the simplest way to read insurance is this: what risk is transferred? What risk stays with you, and what conditions must be met for payment? Before buying or renewing a policy, check the coverage, exclusions, deductible, limits, valuation method, and claim evidence requirements. The policy is useful when the real loss matches the written promise and the customer can prove what happened.